Have you ever wondered which property strategies are worth your time and which ones to avoid? Today, I'll be ranking the best and worst property investment strategies. Think of this as your go-to sheet for smart property investing. My name is Nick. I'm one of the directors at Handle Properties. We're buyers, agents, and property strategists. Let's dive in and kick off with what really works. I'm going to be rating each strategy out of 10. Some will fast track your wealth. Others could end up being really costly mistakes. So I want to break down what each strategy brings to the table and how we see them in a broader portfolio. The first up is the buy and hold strategy. I'd rate this a 6 out of 10. It is the most traditional strategy and works best if you are looking for steady long-term growth within property. With a buy and hold strategy, you buy a property today, rent it out for a good yield, and just watch its value grow slowly over time. There's no flashy strategy here at all, but it's a reliable long-term way to make money. You're not going to double your money overnight, but you'll get consistent returns as property prices and rents naturally increase in that area. But there is a downside. It's slow and it's also expensive. It's all about the long game. So if you're looking for those fast returns, or if you do not have the income to support the expenses over a very long period, this one may feel a little bit like watching the paint dry. It's ideal if you're patient, if you've got plenty of cash flow and household income, but it doesn't work well if you are young and you're looking to stack a large portfolio very quickly. The next strategy is a fix and flip strategy. And here's my take. It's a 4 out of 10. It's incredibly popular, but only if you are treating it as a proper full-time business. The cost of buying a property that is underappreciated and requires that renovation, and then spending all time and effort to find the property, and then all the associated costs such as stamp duty, the actual renovation expense, and all the transaction costs, and a big one is taxes, it's incredibly high. Plus, it's incredibly reliant on market timing and doing it in boom suburbs. You can't just buy any underappreciated property, renovate it, and hope to make money. You're going to also have to be managing all the contractors, coordinating timelines, and making sure that everything lines up perfectly when you do go to sell the property, because every week actually costing you money. The fix and flip strategy can, however, be rewarding, but the cash flow is temporary. You're not building, at least in my view, you're not building a long-term portfolio or creating passive income. It's very much a business if you are in that game and you understand it very well. So this is why I'm marking it a low score on my list. The next strategy is the BRRR strategy, or the buy, renovate, refinance, and repeat. I'd give this one a 7 out of 10. It's like the fix and flip, but with a twist. You get to keep the property and you get to stack the yield and add it to your portfolio. With this strategy, you buy a property that's underappreciated, renovate it to increase its value, refinance it as soon as the value is captured, and then extract out that capital and do it all over again. But you get to hold on to the property and generate that yield, and that's a great way to snowball your portfolio if you're willing to put in the effort. I'm a fan of property because it allows you to build long-term wealth while creating solid cash flow. Unlike the fix and flip, when you're in and out of deals quickly, this strategy allows you to access the equity without paying the taxes, and you get an opportunity to build a portfolio over the longer term. The next strategy is house hacking, and this is my personal favorite. I give it a solid 9 out of 10. If you're young, flexible in terms of where you want to live, and don't mind moving around every few years, the house hacking strategy is fantastic. As a very crude example is you buy a property with sufficient land, you then go out and put a granny flat on it. You either live in the granny flat or you live in the main dwelling, and you rent out the rest and you house hack your way to pay down that mortgage. The more experienced version of the strategy, and one that I'm personally doing, is you buy some land, you redevelop it into townhouses or duplexes, you live in one of the duplexes or the townhouses, and you sell the rest. And that way, the one that you live in is completely paid off debt-free, and it allows you to go out and do this project all over again. It's a straightforward way to scale up your portfolio without taking on the full financial burden of owning the property yourself and having non-deductible debt. House hacking can be a disruptive way, but you'll need to be okay with the idea of moving often, but also having to deal with construction of a property. But if you're willing to make these sacrifices, it's a powerful way to build wealth over the short to medium term, especially if that flexibility is something you're okay with. The next strategy is the Airbnb or short-term rental strategies. I personally rate this a 5 out of 10. Short-term rentals can be highly profitable in the right market. If you get a place nearby the beach or in city locations where demand for smaller units is, quite high and the supply is limited. But it comes with its own challenges, such as increased management, potential regulation in terms of how you structure the subleases, and as well as the general fluctuations in seasonal demand. The biggest hurdle, though, is actually financing. Banks often do not like multiple tenancies or short-term rental income as a part of your overall rental assessment. They prefer that long-term tenancy or the ability to just have a single tenant on the ledger. So that is a drawback. But also on the insurance side of things, the moment you start having a short-term rental or an Airbnb, you're considered to be in business and you don't usually qualify for the general building and landlord insurances available out there. So again, another risk to take into account. But if you can find a property in the right location, it is worthwhile. But there is one way that I would consider doing more short-term rentals, and that is an Airbnb arbitrage method. And what that basically means is you go out as a corporate tenant, get a lease on a 4-bedroom home in the eastern suburbs of Sydney, fully furnish it, provide internet, provide all of the amenities, and then sublease each room for a fee that takes into account all of the benefits, but also gives you a profit. This is one way you could consider doing a short-term rental without actually having to put up the capital of owning the property itself. Moving on to commercial property. This one gets a 9 out of 10. Commercial investments are typically for much more advanced or seasoned investors, but they offer excellent cash flow and long-term leases. This is usually the natural progression for many property investors who have bought a few residential properties and have built a solid portfolio and are now in their consolidation or income phase where it's more about generating cash flow or net cash flow. The downside with this strategy is the capital that's required up front. You usually need a much more larger deposit, often 30% or more. The interest rates are a little bit higher, but it also requires more scrutiny over the lease and the contract. But once you're in, that net return allows commercial properties to often pay for themselves, pay off all of the interest, and give you a cash return that you can start building income from to sustain your lifestyle. The next strategy is subdivisions. I personally give this an 8 out of 10 because subdividing a property can be highly profitable because you get to turn one into 2, 3, or 4 blocks. You're allowed to sell those separately and pay down your debt or almost exterminate your debt. It's not for beginners. It does require a bit of navigating all of the regulations and taking on the risk of whether or not you can subdivide. Because often when you're buying a property, it's not certain as to whether or not you can subdivide it and what are all the requirements to do that. And it can also be very expensive. So for example, I'm doing a subdivision of 1 unit into 3. And along the way, there's about $90,000 worth of upfront expenses that you have to spend that you cannot finance for. And there's a risk that you might spend all of this money and still not get the approvals to do the subdivision. The next strategy is crowdfunding and syndication. I'm giving this a 1 out of 10. This is where a group or a financial investment company will come together and syndicate a large building or a large property development. Everyone equally puts in an investment amount and they run the project and charge fees for this. I don't like these types of investments because they're generally sold by financial advisors. And the main reason is because financial advisors can charge an annual fee on a syndication. But in my opinion, you're better off having direct exposure to property, especially if you're starting out. You don't want to be paying excessive fees to property managers. You want to be able to access the entire deal and have control over that entire deal. So when it comes to real estate, in my view, control is really key. You want to be staying clear of projects where you aren't able to control the outcome. Joint ventures is the next strategy. This gets a 7 out of 10 in my. Again, this is for more complex projects and more complex deals. You might partner with the landowner, provide the capital for the development and the construction, and go into a joint venture arrangement and split the profits appropriately. These joint ventures can be great, especially for development projects where you need to pool resources from multiple parties. And my favorite strategy is a strategy stacker. Stacking strategies together allows you to maximize your returns by layering strategies to suit each property investment you do. Because you don't only want to be doing subdivisions, you don't only want to be doing commercial properties, you don't only want to be doing development or house hacking. You want to be building a diversified portfolio strategy that takes into account the different unique requirements of that particular asset, because not all properties are subdivision blocks, not all properties are high cash flow properties. So you want to be layering your strategies to cover all of the various assets that you have at your disposal. This is a strategy that I personally use. I have a mix of long-term buy and hold. I have cash flow strategies, and I'm also very heavy on subdivisions and development. It matches my risk profile and my risk tolerance. So stacking strategies allows you to play the long game while also creating both cash flow and capital growth. So if you really want to build serious wealth, definitely consider bringing together multiple strategies together that align with your risk tolerance. So what's your go-to property strategy? Drop a comment below because I'd love to hear your thoughts. And also I'd love to hear your thoughts if you do not align with any of the ratings that I provided today. I'd love to know why. And if this video gave you clarity about what you can potentially do in property, don't forget to like and subscribe for more insights.